Options and futures are far different products, but they are both wonderful products for trading, and I'm going to show you the differences between them. All information in this video is educational purposes only and is not an offer or recommendation to trade future stocks, options, or Forex. So this is from Thinkorswim. You can probably find these on most broker platforms, but this is what an options chain looks like. I just thought that was good to post to show, and this is just a little bit of the stuff you could put on there, but maybe some of the complexity of it's more than just buying and selling. So for 101, most simple things, I thought it was important to put the definition. So just being aware, futures contract is an agreement to buy or sell a particular commodity or financial instrument at a predetermined price at a specified time in the future. As you notice, option is pretty similar in its language. Option contracts gives the buyer the right, not the obligation, to buy a call option or sell a put option, an underlying asset at a specified price on or before a certain date. So especially that last sentence, it's extremely similar to a futures contract. That said, they are extremely different derivative products. And so we're going to look into what some of those differences are. Options and futures. Liquidity, which is so important. Options are very liquid if you're trading them on QQQ or on SPX, SPY, the major indices. You shouldn't have too much of an issue with liquidity, depending on when the strike price is. If you're buying leaps, which would be like long-term options, like a year out, the liquidity or the spreads may not be quite as tight, but anything in the next couple of months on the major indices, the spreads will be fine. Futures are consistently liquid, especially on the indices. The commodities sometimes have a little bit larger spreads, but anything on the main contract close to in the first contract month, you're going to have liquidity mostly across futures. Leverage, they're both highly levered products, but they're levered slightly differently. Options have 100 shares per contract, depending on if you have a put or a call. Depends on what will happen with those 100 shares if you hold to expiration. And then futures has the micro contracts and the full size contracts. And the micro, you can have a 0.5x, and then it can go all the way up to 100x. So there's pretty big difference there. Payout curve. So this is important. And we'll have photos or pictures at the end to kind of show this. The payout curve for an option can be convex. I'm not saying it's all convex because there's a lot of different option structures. But it can be convex, meaning it has a very large potential payout relative to the what you put in. Some options, especially their 0 day to expiration options, are pretty common these days. A lot of people day trade with those. The payout can be in the thousands of percent, and that's not across all option structures. But the payout curve can be convex, and there's just a lot of different ways to be paid out in options. And futures, it's linear. It's a 1-to-1 plus minus. It's pretty straightforward. It's pretty easy to understand. It's extremely easy to understand. It's just levered to whatever product you're buying. Now, variables. This is where it can get fun. It could get overwhelming. And the options have so many variables, being the Greeks, which is gamma, theta, delta. There's tons of things. A lot of them are related to volatility. That's not volume, but that's volatility. The implied volatility has a huge part in pricing in options. The price of the underlying is baked into how the option moves. And then the closer it gets to the strike, the further it gets from the strike, the Greeks change. Ultimately, you see what I'm getting at. There are a lot of things that you have to be aware of if you're trading options, because it is not as simple as futures, which is the variable is the market price, and that is it. You're levered to the market, and it's pretty straightforward. So options, they can have the large payouts, but it's way more complex. Not to mention, I believe it's like 80% or more of options that are purchased expire worthless. Options, market makers and institutions that specialize in the options market are typically selling options and taking the premiums, especially these days where there's a lot of demand in the option market, a lot of demand in the futures market. Both of those, the world of derivatives takes up a lot of the total market cap, if you will, of daily volume. Okay, so options, complex, futures, simple. Number of instruments. Options, there's many. Most stocks, not micro stocks and stuff, but any company that you've heard of, like in day-to-day life, will have an options contract. Most stocks have options contracts. There's stocks, ETFs that are with energy, so you don't, and even futures. You can buy options on futures. So there's pretty endless on options number of instruments, different things you can buy options on. And futures, there's still a lot. You get futures on all the commodities. You can get them on the indices, gold, oil, tons of stuff, even currencies. So both of them, I would say, have a good bit of instruments. You shouldn't be at a shortage of what you can trade in either universe. Now, strategies. I mentioned this earlier. Futures, long and short. That's all you can do is long and short. Options, you can long and short via calls and puts, but there are way more strategies you can do with options where you can buy one at a certain price, sell one at another price to use the premium to pay for your other one. There's strangles, straddles, condors, iron condors, verticals, tons of stuff where you can be hoping for volatility compression, volatility expansion, and that is a whole nother, not even video, but course and books and experience, very complex stuff. So ultimately, again, just like with the payout curve and variables, options are much more complex in the strategies. Again, you can do just buy a call, buy or put for the, I guess, simplicity's sake of that being long and short. But even the way those are paid out relative to the price, it's due to the variables, can be a bit overwhelming. And risk. Risk with options, if you're buying an option, you buy a call and you're paying a premium, that premium, you can't lose more than that premium. There's no way, because that's the price of the product. So risk, you can do very calculated risk-wise positions with options. If you're selling options, specifically naked options, meaning you don't own any of the underlying stock, but you're just selling a position, that is unlimited and you can really blow up. If you don't know what you're doing, you should probably never sell naked options. But if you're just buying options, again, risk is limited. And futures, given the leverage, it's pretty unlimited to the downside. Of course, all relative to your account. You could, if you get too much size and the size is more than your account, you can blow up, or you'll end up getting a margin call. So both of them have a lot of risk, of course, as they're derivatives. They are risky products. They have leverage. So those are some of the thoughts with each of the products. This is a payout structure. I'm assuming if you were to guess if this was an option or a future payout structure, and you guess option, yep, you are correct. The way, again, it's just a whole nother class. I'm not here to teach different option strategies right now, but just so you can see, it's not simple. That too, that's an option. these two things look totally different. Why? Because they're totally different structured option strategies. It is, again, a complex world that can be great for hedging, can be great for premium harvesting, you could say. There's a lot of cool things to do with options, but you better know what you're doing, or over time, you will most likely just lose money. Now that, if you could guess what product this is, it's a futures contract. It's linear. There's no weird payout structure. If the market goes down or up by X percent or ticks, it's the same on both sides, and it doesn't matter the time that's passed. There's just no variables other than price, so that's very simple compared to these two. And again, there's way more than these two of crazy looking structures that I could put, but there's really no point of doing that for this video other than you get the point with these. So I hope that this helps understand some of the things with options and futures. If you're just looking to directionally trade, futures and call options and put options are great. Options also has all the other variables with, theta, time decay. If price doesn't move by the date of expiration, your option's still going to expire worthless, even if price didn't go against you. And futures, you will not be losing that. So a lot of info, but this should hopefully maybe point you in a direction where you can find what you're interested in and dig in more from there. So have fun, be safe trading, and make sure you manage your risk.